What's up everyone, my name is Coleman, and in this video, I'm going to be going over the investor who beat the market by over 800% in just 13 years, and some of the ways in which he was able to generate such large returns. Although there's a lot I could cover, I particularly want to focus on how he identified great companies, and then his strategy of when to sell these companies. With that said, I don't want to hold you hostage, and the investor I'm talking about is Nick Sleep, who is probably one of the best investors that many people have never heard of. He actually has a whole chapter written about him in one of my favorite books, Richer, Wiser, Happier, and I'll be using that for some of the information in this video. But first, before we get into how Nick Sleep identifies companies that beat the market, it'd probably be best to go over who he is and his evolution as an investor, since it'll help lay some groundwork for his investing strategy. In 2001, Nick Sleep opened a fund called Nomad Investment Partnership, which he ran with his friend Zach. Over the 13-year period when they ran this fund, it had an average return of 20.8% a year, which easily outperformed the MSCI World Index return of 6.5% a year. In total, over 13 years, Nomad returned 921% compared to the World Index return of 116.9%. So this fund beat the market by over 800%. Twice a year, Nick would write letters to their investors where he would talk about their investments, his investing strategy, etc. These letters are filled with valuable information, which I'll refer to throughout the video. He eventually released these letters to the public to help other investors understand his investing journey, which evolved from cigar butt investing to near permanent holdings. At the beginning, the fund was looking for what Ben Graham would call cigar butt companies, or stocks that were often not great businesses, but were trading 50% below what they were worth. Initially, the fund was pretty diversified, and they often had 18 or more holdings, many of which were cigar butt companies. Over time, Nick and Zach decided that cigar butt companies weren't the best way to invest because it was difficult to continue to find undervalued companies once their current stocks rebounded. So they shifted their strategy and decided they'd rather own a few great businesses that they felt had a long shelf life rather than average businesses that were trading at a great price. In 2014, when they closed down the fund, they had almost all of the fund's money in 3 stocks which they thought fit this mold. These companies were Amazon, Costco, and Berkshire Hathaway. They considered these to be great companies with long shelf lives, which means that these companies would continue to compound for years. In fact, Nick invested almost all of his own money in these 3 companies and left them untouched until 2018, which is when he sold half of his Amazon stake that had risen to over 70% of his net worth. Zach also had 70% of his retirement portfolio in Amazon, and he's never sold a single share. So how was Nick Sleep able to generate such large returns? Well, I want to cover 2 important concepts from his shareholder letters, and that has to do with identifying great companies and then knowing when to sell these companies. First, let's go over how to identify great companies, since this is a key topic he covers in his shareholder letters. After studying characteristics of successful companies like Walmart, Geico, Dell, and Costco, Nick reached the conclusion that many of these companies share a very powerful business model, which he calls scale economies shared. Sleep says scale economies shared are where increased revenue breeds scale savings, which breeds lower costs, which breeds lower prices, which leads to increased revenue. So basically, the scale economy shared business model is where a company's scale allows them to lower prices for customers, which in turn leads to more customers and increased revenue. This is an extremely powerful business model because it can help the company grow while also giving them a moat or a competitive advantage. When a company is able to get to the point where they can get cost savings from buying their products in bulk, negotiating better deals, etc., and then pass those savings on to the customers, it can box out the competition while at the same time helping the company grow because most customers want cost savings. In Nomad's 2009 partnership letter, Sleep says there are very few business models where growth begets growth. Scale economies turn size into an asset, and companies that follow this path are at a huge advantage. Typically, these types of companies are customer focused and keep their prices low rather than trying to have the highest margins possible. So they defer profits today in order to extend the life of the company. According to Nick, some of the best examples of companies that fit this mold were actually two companies his fund invested in, and that is Costco and Amazon. With Costco, they stick to standard markups achieved through scale, which are then returned to customers in the form of lower prices. For example, Costco prices their products 14 to 15% above wholesale price, period. So if a product costs $1, the most Costco would sell it for is $1.15, although they could sell it for more. One time, Costco purchased jeans for an all-in price of $22 a pair. This was $10 less than the firm had sold the jeans for in the past. Costco could have marked up the jeans by about 50%, but as usual, they only marked them up by 14% and passed the savings on to the customer. In the end, this results in more customers, which results in more revenue. Sleep thinks Amazon is very similar and also benefits from scale economies shared. For example, in Amazon's 2005 annual report, Jeff Bezos said, "We have made a decision to continuously and significantly lower prices for customers year after year as our efficiency and scale made it possible. Our judgment is that relentlessly returning efficiency improvements and scale economies to customers in the form of lower prices creates a virtuous cycle that leads over the long term to a much larger dollar amount of free cash flow, and thereby to a much more valuable Amazon. We have made similar judgments around free Super Saver shipping and Amazon Prime, both of which are expensive in the short term and we believe important and valuable in the long term." That was said in 2005, and you can see how that has turned out today. So in Nick Sleep's judgment, scale economies shared is one of the most important factors when looking for companies that will have a long shelf life. They're able to offer low prices and defer profits today in order to grow and extend the life of the company. He says there are not many companies like this out there, but the companies there are at a huge advantage. Now, identifying these companies is important, but according to Sleep, knowing when to sell is another very important factor that many investors get wrong, which is why he talks about this pretty extensively in his letters. Sleep has said the biggest mistake an investor can make is to sell a stock that goes on to rise tenfold, not from owning something that goes into bankruptcy. In another letter, Sleep said again that the biggest mistake an investor can make is to sell a Walmart or Microsoft in the early stages of a company's growth. So knowing when to sell a stock is very important. Sleep likes to keep his strategy on selling quite simple, and if I had to summarize it, I would say his strategy is that once you find a great company, hold on to it and let it compound. And if the business is getting better, why sell? He considered many of their core investments to be near permanent holdings, and Nomad's average holding period for their stocks was over 5 years, while the industry average holding period for those same stocks was only 51 days. This is because he says many fund managers would rather sell shares for a small premium now and market their short-term performance to new investors, while turning a blind eye to the doubling of the sold business over the next few years. He thinks this is a scandal which he tries to avoid. Additionally, he thinks most investors don't recognize factors like scale economies, which can lead to a business's success, which is why early investors no longer own companies like Walmart, Amazon, and Costco. For example, when he bought Amazon early on, around $30, he said it would have been very easy for him to claim a victory, high five, and sell their shares after the price had doubled. However, given his understanding of the business and the probability of it reaching that destination, it made sense to keep Amazon at such a large position, and he thought selling Amazon early on could be the equivalent of selling Walmart in 1980. So they ended up holding the position until the fund closed, and as I mentioned earlier, he didn't sell any of his personal Amazon stake until 2018 when he sold half of it. And you could argue he still sold too early. Overall, Sleep believes in holding great businesses for an extended period of time, which is one of the reasons why he was able to generate such large returns. And I think this is a very important lesson. Between his strategy of identifying companies with a long shelf life and then holding on to those companies for years and sometimes decades, I think Nick Sleep shares some great investing lessons that can be easily implemented. Also, if you'd like to read any of his partnership letters for yourself, I'll include the link to those letters down below. With that said, if you liked the video and found it helpful, don't forget to hit the like button, and if you want to see more videos like this one, please subscribe down below and hit the notification bell. Thank you so much for watching, and I'll see you in the next one.